Hi everyone, welcome to today's episode. When we look into the property investment, we think about where to buy, how much I can borrow, but one of the very important things that we always miss is what entity structure should I buy the property in. Entity structures like whether it will be in individual names or I have to set up a structure like a trust, company, super fund or something else to actually buy this property in. Exploring this whole options of entity structures and how taxation and lending works with these structures, I've got Sam from First Step Loans and Raj from Auto Accounting, and together we're going to discuss the whole structure around the property investment. Okay, welcome Raj, welcome Sam.
Thanks, Bimal. Thanks for having us. Definitely, I will explore more about the different structures available because that's the thing where people don't know what options they have and they might miss the tax benefits.
Yeah, sure. So Sam, let's start with you. Does actually structures matter when it comes to the lending?
It definitely matters big time because the structures allow us to determine the purpose of the loan, obviously the investment on owner-occupied, but what it also does is changes the interest rate and more importantly changes the borrowing capacity and negative gearing we can take into consideration.
Yep, sure. So, Raj, what are the structures that actually available when we say structures? Like, what are the various structures?
Yep. So, most common one which everyone know is the personal. When you buy, or the partnership, when husband and wife usually buy. Other options are trust, companies, and also the self-managed super fund. So, these structures are available for person.
Yeah. So let's start with the first one, which is very common structure, saying buying individually, whether in one name or jointly. So Sam, when someone is coming for lending or borrowing and they says, I want to buy this property under my personal name, how the lending works there?
See, generally people go with a normal, if it's a husband and wife, they'll go with joint. But at the same time, some people will say, okay, I'm buying it for investment. For example, my client, she bought it for investment, short term, so she's on a higher income, her husband is on a lower income. In that case, what we did was, because it was short term, so we were looking at more capital gains tax. So in that case, what we have done is we have done a larger share of the portion for him, because he's lower income, and for her, it's because she's on a higher income, so she's on a 10% shareholding. So at the end, when the capital gains tax hits, he gets the 90% of the profit on a lower income. That means less tax. She gets the 10% of the income at a higher tax bracket, which is again lower tax.
Raj, what about the taxation side of when they are buying individually, whether in one name or more than one?
Yep. So as Sam mentioned that there are some percentage you have to decide at the start when you're buying the property. So whatever percentage you decide, that is the percentage you're gonna share your profit, and if there is a profit from the property, that will again add it back to your taxable income and you will be paying the marginal rate. So it depends on which tax bracket that individual is. So if you are on the higher bracket, then you might be paying the 45% tax in there. And if you're lower bracket, you might pay the lower. So it all depends on your, just taxed on your marginal rate.
Yep. So the tax is actually the individual capacity there.
That's right.
Yep. Yes. Right. And same as the lending is also in the individual capacity as well.
Not really. The lending is always on the joint capacity. So
okay.
If two people are buying, regardless it's my 10% share or 90% share, we are using a combined income, which works in the favor sometimes because most people are on different income brackets, but it doesn't mean that because the one person has a lower income that they get lower money. It's just the full income and total liabilities and obviously state's dependence. That overall makes the difference in the borrowing capacity.
Okay, yep, yeah, that makes sense actually. So now let's go to the next structure, which is companies, as you mentioned. So when someone is buying in the company, how it's different from buying an individual name from the tax perspective?
Yep. So if you are buying into the company, one thing which is different is the asset protection. So if you're buying any property into the company structure, you will get the asset protection, while in individual name, it is your personal assets, if anything happen in future, then your personal assets is a risk as well.
Yep.
And if you buying under the company, you need to consider what's your plans are, whether you are buying to have the property for a long term or a short term. And one thing to consider here is, in the company you won't get the 50% CGT discount if you are, whenever you are selling it in future.
Yep, which that's available currently
Yeah,
in the individual names.
that's right.
Yep,
Yeah, right. There's a flat tax, right? So
And from the lending side, is it lending still same if you're buying in a company versus if you're buying individually?
That's the most important thing there, that the company under which we are buying should not be a trading entity.
Okay.
Because if it's a trading entity, it's totally a commercial loan, not a residential loan, and commercial loans are totally different ball games, much higher deposit, much higher lending criteria. Where if it's an individual name, then it's an individual income basically, which is supporting the loan because the company is not trading, so no income as such.
Yep.
So, say a husband-wife family trust, they're buying a property under a trust and a company, then their combined income gets supports the purchase of the investment property.
Yeah. And you touched the trust part there, which I think from lending, whether you're buying in a company or a company and a trust is similar.
Exactly.
Yep,
So
yeah.
it doesn't matter as far as we are concerned if it's a corporate trust or an individual trust. Obviously, some banks will not lend to corporate trust nowadays because it's getting harder. So individual trusts, you can have more bank options, corporate trust less bank options.
Yeah. I think, but from taxation side, they are different. Company
yes,
and
they
trust.
are
Can you-
definitely they are
elaborate more?
different. So asset protection, company and trust both gives you the asset protection, but not the individual one. But in the trust one, it flows or it has to be distributed to the beneficiaries.
Okay, the
So,
income from that.
Income from the trust, if its property is positive gearing, and if the property is negative gearing, then the losses cannot be distributed.
Okay.
So that means if in personal name you can offset the negative gearing against your other income, but while if it's in company or in trust, the losses stays in to the company and in the trust, and your it will carry forward for the future.
So when we say carry forward for the future, it means if tomorrow that's a positively geared company, we can still offset against the income in future years.
Yes, that's right. That is possible. So it's not immediate tax benefit. It is
It's going
Yes.
forward. Yep. Yeah.
And just very quickly on that point, if you buy it under trust and a company, then the banks don't take negative gearing as well. So it's a lesser borrowing capacity to begin with when buying under trust.
Okay. Yep. Yeah. So that's a very, very good point, because the borrowing capacity changes when property is negatively geared in the company or trust structure.
Yes.
Yep. Okay. Now that's good. So we covered the individual company and trust. Now we come to the super fund or buying in the super fund part. So buying in the super fund, it's a very different strategy altogether, because when you're buying in individual trust or company structures, you are looking at your before retirement goals. Whereas when you're buying in a super fund, you're looking your retirement goals, which means that this property you are buying is not for today or tomorrow. It's actually after you retire, which is either 60 or 65, depending on your circumstances. So yes, you can buy in super fund. Very hard and strict rules applies, and the goal is not today. Goal is for your retirement. When you are buying in super fund, the taxations rule are very different as well. So you pay 15% tax on income, 10% tax currently on capital gains. Once you are retired and the fund is in pension, there's no tax to pay on income or capital gains. Saying that, like companies and trust, you can't use the negative gearing against your personal income, but you can use this negative gearing against the super fund income, which means that you can actually offset the loss from the property against the super contribution that your employees makes, which gives you a like 50% tax benefit there. But it's not like how you do that under individual names. So that's the difference when you're doing buying property in a super fund from the tax side, but it's a very different from the lending side as well, isn't it?
Yeah, it is. The good thing about SMSF or self-managed super fund is your personal liabilities are not a problem. You might have a $10 million debt or $1 million debt or no debt, your super income and super loans are independent of your individual loans. So
Yep.
all we need to know is how much debt you have under your super. Generally, if it's a new one, there's none, and how much contribution you're making into the super. So your contribution into the super and your rental income will together determine how much you can borrow on your SMSF.
Yeah. And am I right that not the big four banks, they don't give the loan to the super funds or buying a property in the fund, and you have to actually go to the second tier banks via broker, isn't it?
Kind of, yes. The big four have totally come out of the self-managed super fund lending. So now we have a late entrant, AMP, which is one of the very big
Yes,
banks.
they come
They have
into
come
the
up.
market.
They have come up as a lender for SMSF with very good rates, very good products. But other than that, it doesn't really matter so much because all the financial institutions are governed by ASIC and APRA. So same rule applies, and you are not going into a wrong hand. Even if you're going for some unknown financial institution, always check, I will say, but brokers generally will always find you a good solution.
Yeah. Now, just a question to both of you. When someone is thinking of, okay, I want to get into investment and into the property market investment, what will be the first question they should be think about? Whether it is to where to buy or whether it is what structure I should buy in?
They should look into and talk to the professional in the field. Two things are important. Definitely need to know what structures are available in their situation because it depends on each person's.
Yeah.
One structure which might be good for one person may not be good for the right one. So that's very important. And second thing, definitely Sam will answer on that one. They need to also look into their borrowing capacity. So
Yeah, that's exactly what Raj said. What the first thing you have to determine is what's your goal? Why you're buying it? Is it a long-term capital gains or is it just negative gearing? If it's negative gearing, then you are probably not looking at corporate and trust structure.
Yes.
If it's long-term capital goals, then you have to see how much income you are on, how much income is if there's another person she's on or he's on, and make sure the structure, the ownership percentage is according to your income. So just don't go on negative gearing because negative gearing, if you see any property, like I'll do a simple maths, it doesn't last more than 5 years, typically. After 5 years, you are pretty much positively geared,
Yes.
and then you are worrying about capital gains now. And capital gains is always much higher and
Compared
much
to-
more taxation than the negative gearing what you would have got.
Yeah. And that's exactly right because, and I think Raj, you agree with this one. When someone comes and they says, I want to do it 90%, 10%, you are thinking about today or next 5 years until the property is negatively geared. As soon as it's flipped, it's a positively geared. The person who's got 90% is now worse off because paying more tax and paying more capital gain in future as well.
That's right.
Yeah.
And this is the thing which it can be changed in future, but there are costs. Like they will be paying the stamp duty and the CGT definitely, so they will end up paying more. So it's not the thing like until it's negative getting, let's do 90% to the higher income earner and then become positive, change the percentage. You can't change the percentage. That's
Exactly. So you can't change it, and yes, you mentioned it correctly. That's and very important point that stamp duty applies, which means that it's not that you can just change the structure anytime. And I think from lending it's even harder, isn't it?
Not much difference in my scenario where lending is like you have a 90% ownership or 10% ownership because we are using a combined income always. So we don't. It doesn't affect us, but it affects you in terms of the negative gearing. It will affect slightly in terms of how much more you can borrow.
Okay.
Not much more difference, but
Yeah.
I'll say focus on what's your goal, short term, long term. If you're selling in next 3 to 5 years, concentrate on negative gearing. But then 3 to 5 years, also think of capital gains tax. Always think capital gains tax.
Yes.
If it stays after 2-3 days. So,
Yes. And the thing is, I think if it changes next Tuesday, it's a more to put the consideration in now because capital gain tax is there now. If as the rumors are, it's going to reduce the benefits is reduced, which means that you're going to pay more capital gain tax. Then these strategies are even more important in future.
it will say the strategy is the most important thing always, regardless. We have to think the capital gains tax. Yes, I know we are we have pulled off the capital gains tax. But at the same time, you have to think, are we looking at a bigger gain or a smaller gain? Capital gains tax is not the reason I buy a property. I look at, if I buy a property today for $500,000 and in 15 years time that $500,000 becomes $1 million, that's a $500,000 income. Then regardless if it's a 50% tax or a 100% tax, generally you won't have saved that much money in a normal world.
Yes.
Plus, if you don't sell it, there's no capital gains tax, and it's a guaranteed income as a rental income in 15-20 years time when you would have paid off the property.
Yeah, very, very, very good point, because we always look at the wrong side of it. So instead of looking at how we are growing our wealth, and we are actually looking at how to save the tax, and tax is not stopping us to actually grow in our wealth.
Some people, they do think that because I'm paying more tax, let's buy a property and save the tax. That's what their thought is. But what you need to think is, before investing, why you are going for this property. What's your goal? What you want to achieve from it?
Yep.
Once you're clear with that one, then you plan and talk to your accountants and brokers, get more information, and then you plan accordingly.
Yeah, sure. So one question here, Sam. Yes, you mentioned that if the structure is changing in terms of percentage, borrowings doesn't change that much. What about if someone buys a property in a trust or company and later on say we want to move that property into personal name? We know that stamp duty and all capital gains comes in picture, but what happens in the borrowing side?
It will generally increase the borrowing capacity because let's assume today's scenario where we have negative gearing in place. So when the negative gearing is added, you will find you can borrow more, and because now it's individual income, individual name, so we can add negative gearing, and that goes straight back into the more borrowing capacity. Having said that, it's not that $500,000 will become $1 million. $500,000 will become maybe 600, and mathematically speaking.
Yeah. So, but this will be the whole new loan, isn't it, for them? They have to redo the whole loan?
It will be the whole loan. The moment, just remember always, the moment the name on the title changes, the loan will change. We have to rewrite the loan. We have to reassess the borrowing capacity. We have to make sure you have the income and everything. So it's not just, it's the same 500,000, now it's in my name and not the company or trust name, or even the other way around.
Yeah.
The moment you change the names on the loan, husband to wife, wife to husband, families, whatever, you will always reassess the loan.
Yeah. And that's why it's very important to actually know which structure you are buying the property in before you go for lending or sign a contract, because it's not easy, it's close to impossible to actually change the structure later on because of the stamp duty, redo the loan, establishment cost, and so many expenses come in place, which will take all the benefits that you are trying to achieve by changing the structure, isn't it?
Exactly, and signing the contract, what Bimal mentioned, that's a very important part. At that point, just stop for a second and think, am I buying it together in one name, two names, trust? Speak to your accountant, most importantly. Speak to the conveyancer. What am I signing? Anything you sign becomes a legal document. You cannot just go and say, I want to change the name on the contract now.
Yeah.
The contract has to be cancelled, and there are repercussions on that as well. So.
Yes, yeah. And which we see very much and very often in the SMSF properties, because people don't realize and they put the wrong name on the contract. And if the name is incorrect on the contract, lending will affect, your taxation will affect, and more importantly, your stamp duty with the SRO will impact. Like I have seen where people sign the contract with Superfund name instead of bare trust name, or vice versa, or even personal names as well, and then the whole implications comes in.
As a simple tip, I'll say if you are doing a purchase for SMSF or a trust or a company, always sign and or nominee.
Yeah.
Sam and or nominee. That's it. 3 words, and or nominee.
Yeah.
That will save your life. It will cost maybe sometimes a few $100 extra.
Yep.
To get it
To the
update
nominations.
the name.
Yeah.
But you will save thousands of dollars and hours of follow up
Yeah.
to correct the name later on.
Yes, yeah. But the thing is, that only applies to few states, because if you go to the Queensland or WA, there's no and or nominees, so that the contract has to be under that name.
So then you don't sign a contract.
Yeah, exactly.
You go to the broker, you go to the bank, get the loan sorted. Once it is unconditionally approved, then you go and sign the contract.
Yeah.
And they allow you to do, when I say they, the vendor will allow you to wait for that many days because they know that they cannot change the contract.
Yeah, yeah, and exactly, and that's why we say it's very important to talk to the professional. The first thing I think whenever you're looking into investing, decide what the structure need to be. Now, it's not just the investing. I'll just a little bit touch on the primary residence as well, because there are some people who may not want the property under their personal name, they're gonna live in that one. But that's something you need to talk to the professionals. You need to talk to your accountant. You need to talk to your broker, because they will let you know what's the best structure you can go with to buy that property. And as Sam said, it's a goal. It's a goal you are looking at here. Whether you want to do a negative gearing, save some tax, or whether you are buying for your retirement, for an income in your retirement, so it's a self-managed super fund, or any other reason, what you are doing is you are trying to build your wealth. And if that is not happening and you are losing the money just by doing the wrong things at start, that's going to cost you a lot. So, yep. Any final points you think our viewers should be aware of?
I think we have discussed that a lot and talk about that more in this video, which is don't just take the step. Do your search, talk and ask as many questions as you have to your accountant, to your broker, and get the clear picture, know what are the pros and cons of each structure which is benefit for you, then only take the step. And as Sam says, do not sign any document before knowing what's behind it.
Yes, exactly. And that's where it comes with the self-managed super fund as well. If you are thinking of buying a property in the self-managed super funds, there are a lot of steps that you need to do, and there are a lot of things that you need to consider. It's not that because my friend bought in the self-managed super fund, I can buy as well. It's not, because everyone's situation is different, everyone's goals are different. So you need to give it a good thought, do your research, due diligence, and talk to us if you want to go that path.
Yeah, I'll just say, just remember a few things. One is investment, SMSF is not for everyone.
Yes, exactly.
So if someone is saying, I did SMSF investment or I bought a property XYZ, it worked great, it might have, but not for you. Probably not because of you, but because of the time. He bought at a great time, not anymore. Do your research, speak to your brokers, and define your own goals. We will not define your goals. We can help you sharpening the goals, but you define your goal. Do I want capital gains tax? Do I want negative gearing? Do I want to invest my money? Do I even have the capacity to invest the money?
Yes. I think you've got enough information about the structuring side of there, but if you still want to know more about that, whether it's from the taxation side, asset protection side, or lending side, please see all the contact details for Raj and Sam in the descriptions. Get contacted with them. And till then, wait for our next episode. Thanks. Thanks, Raj. Thanks, Sam.
Thank you, Raj. Thank you, everyone.